I want you to try and visualize a number right now.
Okay.
Don't just hear it, but actually try to picture it in your head. $180 billion.
That is a staggering amount of zeros.
Right, it's astronomical. And here is the kicker for you. That is not a year.
No, definitely not.
That is not a decade of savings. That is just 3 months, specifically the 3 months ending October 31st, 2025.
Which means we're talking about Walmart's latest quarterly filing.
Exactly. We're diving into their 10Q.
And to put a really fine point on that number, they are generating roughly $2 billion every single day.
$2 billion a day.
Yeah. That revenue figure for just a quarter is larger than the entire annual GDP of countries like Ukraine or Kuwait.
It's hard to even wrap your head around. And when you see a number that big, the headline usually just writes itself right.
Sure, yeah. Walmart is a retail juggernaut.
Right. Or Walmart is growing. And obviously they are. But today on this deep dive, we're not here to do a victory lap for their grocery sales.
No, we are not just looking at the receipt tape today.
Exactly. We are going straight for the footnotes.
Because, frankly, the 10Q filing they just dropped it's absolutely wild if you know exactly where to look.
It really is. On the surface, it looks like a standard retail earnings beat. You know, they sold a lot of stuff.
Yep.
But when you actually peel back the layers of this document, you find a massive fintech play happening in India.
Mm-hmm.
You find this billion-dollar swing in the stock market that's heavily padding their bottom line.
Right.
And a legal calendar that is booked out literally until late 2027.
It completely challenges the very definition of what this company is.
It does.
You start to realize that the store, the physical place where you go to buy your milk and your socks, is increasingly becoming just a front.
A front for what?
For a massive global investment engine.
Okay, that is a highly provocative way to put it, but I love it. So let's unpack this for everyone listening.
Let's do it.
We have to start with the profit surprise. So the top line revenue was $179.5 billion.
Which is up nearly 6% from last year.
Right, that's really solid. And for the full 9-month period, they hit over $522 billion.
Huge numbers.
But then I looked at the net income. It jumped to over $6.1 billion.
Right.
And that is a massive leap from the $4.7 billion they made the exact same time the year before.
It is. And if you are just a casual observer, the immediate assumption is, wow, they must have sold a lot more high-margin electronics.
Or maybe everyone just decided to switch to the fancy organic kale this quarter.
Exactly. You assume it's a product mix thing.
Right. I'm thinking they just pushed a lot of expensive inventory.
And they did sell more, sure. We will get to that.
Mm-hmm.
But that is not actually where that massive profit jump came from.
Okay, so where did it come from?
You have to scroll down the income statement to a line item that, honestly, most people completely ignore.
Which one?
It's marked in other gains and losses.
Ah, the catch-all bucket.
Precisely the catch-all. In that bucket, Walmart recorded a $2.1 billion gain.
$2.1 billion.
Yes. And that gain came primarily from changes in the fair value of their equity investment.
Wait, hold on. $2 billion. That's roughly a third of their total profit for the entire quarter.
Correct.
And it's not from selling physical goods.
Not at all. It is from the stock market.
Wow.
Walmart holds strategic stakes in various companies. You've got JD.com in China or Symbotic in the supply chain robotic space.
Right.
When those companies have a good quarter or when the broader stock market just rallies the Christmas, the value of Walmart's portfolio naturally goes up.
And they get to book that paper gain as profit.
Exactly.
So they didn't make that money scanning barcodes at the checkout lane. They made it because the stocks they hold went up.
Exactly. And here is where it gets really interesting for you as a listener trying to understand the actual risk profile of this company.
Okay.
Compare that massive gain to the exact same quarter the previous year. In 2024, they actually lost money in that specific category.
Really? So you have a massive swing from a loss to a multi-billion-dollar gain.
Yes. That swing is responsible for a huge chunk of their reported profit growth this quarter.
That's wild.
It creates a fascinating distortion. It highlights just how exposed Walmart is to the broader financial markets right now.
It's not just about retail.
Their bottom line isn't just about retail efficiency anymore. It's heavily tied to financial engineering and investment performance.
It's almost like finding out your local neighborhood grocer is actually running a hedge fund in the back office.
In a way, yes. Think about it. If the market tanks, Walmart's net income could take a massive hit even if they sell every single banana in their inventory.
That is a perfect segue, actually. because while the hedge fund was making money, the actual stores, the U.S. engine were cranking pretty hard too.
Oh, absolutely.
I don't want to shortchange the retail side of the business here.
No, we definitely shouldn't. Walmart U.S. net sales hit $120.7 billion.
But the number that really stands out to me in the U.S. segment is the comparable sales growth, the comp sales.
About 4.8%.
Which, for a company of this sheer size and maturity, is like moving a mountain.
It really is.
You usually see 1% or maybe 2% growth for giants like this.
It's highly impressive. But you have to ask yourself, where is that growth actually coming from? Is it just more foot traffic, more people walking through the automatic doors?
Well, the report specifically mentions something called store-fulfilled pickup and delivery.
And this is the critical shift in their business model that has been quietly happening over the last 5 years.
Okay.
E-commerce contributed about 4.4% to that total comp sales growth.
Almost the entire thing.
Exactly. But here is the absolute key to understanding this. That e-commerce delivery isn't coming from a distant massive warehouse 3 states away.
It's coming from the store down the street.
Yes.
So when I go into my local Walmart and I see those massive carts with the blue plastic totes and the employees sprinting around picking items directly off the shelves.
That is literally the growth engine.
That's the 4.4% right there.
That is the engine. Historically, e-commerce was a massive margin killer for traditional retailers.
Because of the overhead.
Right. You had to build a brand new dedicated warehouse pay for expensive shipping pay for the cardboard box, the packing materials.
Right.
Walmart has completely inverted that model.
Yeah.
They are effectively turning their thousands of existing retail locations into micro-fulfillment centers.
Which is brilliant because they already own the real estate.
They're utilizing the square footage, the electricity, and the inventory they are already paying for.
And honestly, that speed is just hard to beat. If the inventory is literally 5 miles from my house, I can get it same day.
Exactly. It's fundamentally a logistics play at this point. And the internal data suggests it's working across the board. Grocery, health, and wellness, general merchandise, they are seeing strength in all categories.
And who is actually buying this stuff? Because the traditional narrative has always been that Walmart is strictly for the budget-conscious shopper.
Right, the bargain hunter.
But I'm seeing data here about the average ticket going up significantly.
That demographic is shifting too. The report notes a distinct increase in both the average ticket size and the number of transactions.
So people are buying more stuff more often?
Yes. What retail analysts are calling this is the wealthier shopper phenomenon.
Is that like the trade-down effect we hear about?
It's a bit of that, but it's more of a consolidation effect.
Okay, explain that.
Imagine a household making well over $100,000 a year. Previously, they might have gone to a specialty organic grocer, then driven to a pet store, then over to a pharmacy.
A lot of separate trips.
Exactly. But with inflation still being a very fresh memory and time being the ultimate luxury,
Yeah.
they are consolidating.
They just go to one place.
They are going to Walmart and buying absolutely everything at once.
So they might come in for the cheaper milk, but they end up staying for the electronics and the home decor and the patio furniture.
And that dynamic pushes up the average ticket significantly. Once those higher income shoppers change their established routine, they tend to be very sticky.
They realize the convenience factor is just too high to ignore.
Exactly.
Okay, so the U.S. business is firing on all cylinders. But let's look outside the U.S. now, because this is where the story gets really messy.
It does.
And honestly, much more intriguing, this is the international intrigue section of our deep dive.
This is exactly where you have to read the footnotes incredibly carefully.
Right.
International sales overall were actually up,
Yeah.
which is obviously good. But then look at the operating income for the international segment. It completely tanked.
It dropped from $1.2 billion all the way down to $702 million.
Yep.
That is a really steep drop, a 40% decline in profit.
Roughly, yeah.
If they are selling more stuff overall, why are they making so much less money overseas?
There are two main factors driving this drop. One is a temporary calendar quirk, but the other is a massive strategic play that really signals where the entire company is going in the next decade.
Okay, give me the calendar quirk first. Let's get the boring accounting stuff out of the way.
Fair enough.
Yeah.
The quirk is related to Flipkart, which is their Indian e-commerce giant. They run a massive annual sales event called the Big Billion Days. Think of it like a localized Prime Day or Black Friday.
Huge discounts and massive volume.
Exactly.
Yeah.
And also massive expense. You have marketing, logistics, shipping subsidies.
Right.
Last year, that massive event fell squarely in the fourth quarter. But this fiscal year, the calendar shifted, and it landed mostly in the third quarter.
Ah, I see. So the heavy expenses hit this quarter, which messes up the straightforward year-over-year comparison.
Right. It creates a timing mismatch. You have the heavy costs hitting now, whereas last year you didn't. So that explains a good portion of the profit drop.
Okay, that makes sense.
But the second factor, the $700 million charge, is the one we really need to focus on.
Yeah, I saw this specific line in the footnotes. A $0.7 billion, quote, non-cash charge related to PhonePe.
PhonePe, yes. For those listening who might not know, this is the absolute dominant digital payments app in India right now.
It's huge there.
We are talking about a market with 1.4 billion people that is rapidly digitizing its economy. And PhonePe is essentially the digital wallet they are all using.
And Walmart actually owns them.
They own a majority controlling stake, yes. But here is what happened in September 2025.
Okay.
PhonePe modified its share-based payment arrangements. Basically, they fundamentally changed how they are compensating their executives and employees with company equity.
And that accounting change cost Walmart $700 million.
It triggered an accounting charge, yes. But you have to look at what else happened simultaneously. Following this modification, Walmart's overall ownership in PhonePe dropped.
It dropped from what to what?
From approximately 84% down to 73%.
Wait, they diluted their own stake? They voluntarily gave up 11% of this massive company.
Yes, they did.
Why on earth would they do that?
To prep for an IPO, an initial public offering.
Oh, I see. That changes everything.
Exactly. When you are getting a massive high-growth fintech startup ready to go public, you have to clean up the capitalization table.
Make it attractive to Wall Street.
Right. You have to deeply incentivize the management team and the key employees who are actually going to drive that public listing. You need them to have serious skin in the game.
So Walmart is essentially taking a hit right now.
Yeah.
They take that $700 million charge and they accept a lower ownership percentage.
Right.
Because they firmly believe that the ultimate value of PhonePe as a public company is going to be astronomical.
It is a textbook pain now for gain later move.
Right.
By accepting the dilution and the accounting charge today, they are betting that 73% of a publicly traded high-growth fintech giant is worth significantly more than 84% of a private subsidiary.
That perfectly connects back to what we said at the very beginning of the show.
Yep.
Walmart isn't just selling groceries in Arkansas anymore. They are actively incubating a fintech unicorn in Bangalore.
It is a highly sophisticated global portfolio strategy. They're utilizing the massive reliable cash flow from the U.S. stores to aggressively fund these high-tech ventures in emerging markets.
It's brilliant.
It is. But while they're looking forward to that massive IPO payout in India, they are also spending a significant amount of time looking backward at some very serious legal baggage back in the U.S.
Yeah, the legal section of this 10Q was dense.
Very dense.
And frankly, a little scary if you are an investor. It really feels like every single time they manage to close one case, another two just pop right up.
It's the cost of scale.
Let's talk about the opioids situation first.
It's a bit of a mixed bag. The good news for investors, and honestly for the company's immediate cash flow, is that the massive nationwide settlement we've discussed on previous deep dives is completely done.
Okay.
That $3.3 billion accrued liability is fully paid off as of January 2025.
Okay, so the big check is cleared. That specific chapter is closed.
Settlement chapter is closed, yes.
Yeah.
But the broader litigation chapter, not even close to being over.
Because of the DOJ.
Correct. The Department of Justice still has a massive civil litigation pending regarding Walmart's specific pharmacy dispensing practices.
Right.
They are formally alleging widespread violations of the Controlled Substances Act. And the filing finally gives a specific date. The trial is officially set for November 2027.
2027. That feels like a lifetime away, but in corporate legal defense terms, that is basically just around the corner.
It really is. And you have to remember, a trial is fundamentally different from a negotiated settlement.
Yeah.
A trial means public evidence.
Yeah.
It means daily negative headlines. And if they actually lose, it means potential penalties that could be absolutely staggering. It introduces massive uncertainty.
And there is a brand new threat that just popped up in the filing too, right? The whistleblower case.
Yes, a False Claims Act litigation. 2 former Walmart pharmacists filed a suit that was just recently unsealed in April 2024.
Okay.
Now, the DOJ actually declined to intervene in this specific one, which is usually a pretty good sign for the corporate defense.
Because it means the government didn't think the case was quite strong enough to join themselves.
Exactly. But The plaintiffs, those two pharmacists, are legally allowed to proceed completely on their own.
So they have rogue pharmacists coming after them on one side and the entire DOJ coming after them for a separate massive trial on the other.
It really never ends.
And that is just in the U.S. If you look at the global legal headaches, it gets even more complex.
Oh, absolutely.
I saw the Mexico ruling, COFES. Am I saying that right?
COFES. COFES. Yeah. Yes, the Mexican Antitrust Authority.
All right.
They formally ruled in late 2024 that Walmart's local subsidiary engaged in relative monopolistic practices.
That phrasing just sounds bad. Monopolistic practices?
The actual financial fine was tiny relative to Walmart's overall size. Yeah. It's about $5 million US.
Barely a rounding error.
Right. But the ruling also imposes non-structural conduct measures regarding exactly how they are allowed to negotiate with their suppliers. That is the real systemic risk. If international regulators start actively dictating how Walmart can negotiate wholesale prices, that strikes at the absolute core of their entire business model, which relies entirely on scale and leverage.
But the one lawsuit that really stood out to me in the international section was in the UK.
The Asda case.
Yeah, because Walmart sold Asda, right? They don't even own it anymore.
They sold the vast majority stake, yes.
Yeah.
But, and this is a mass, but they legally agreed to indemnify Asda for certain pre-existing claims.
Okay.
Basically, they said, we sold you the house, but if the basement floods because of the specific plumbing we installed a decade ago, we will still pay for the damage.
And I'm guessing the basement is currently flooding.
The basement is filled with a massive equal value employment claim. We are talking about 73,000 current and former employees.
73,000. What exactly are they claiming?
It's a complex labor economics argument. Mostly female store workers are formally arguing that their retail work is of equal intrinsic value to the distribution center workers.
Who are mostly male.
Who are mostly male and who are paid a higher hourly wage. If those store workers win the mandated back pay across 73,000 people, could be absolutely enormous.
Wow.
And the next major phase of those legal hearings starts November 23rd, 2026.
So even though they literally sold the company, the ghost of Asda is still actively haunting their corporate balance sheet.
Exactly.
It's a contingent liability.
It's just a harsh reminder that when you operate at this massive global scale, the legal shadow is incredibly long. You can't just sell a division and cleanly wash your hands of the past immediately.
Speaking of very expensive operational liabilities, let's bring it back home to Sam's Club.
Sure.
Because I feel like Sam's Club is often the unsung, steady hero of the Walmart portfolio. It's the subscription membership model. It's usually very steady.
It is a very consistent performer. Comp sales for Sam's grew 2.8%.
That seems a little bit low compared to the Walmart U.S. figure of 4.8%, doesn't it?
On paper it does, but you have to actively factor in the fuel drag.
The fuel drag.
Sam's Club sells a massive volume of gasoline. And gas prices were significantly lower this quarter compared to the same time last year.
Ah, I see.
That naturally pulls the total top-line revenue number down significantly.
Yes.
Just because the actual price at the pump is lower.
So the headline revenue number lies a little bit there.
Exactly. If you completely strip out the fuel sales and just look at pure unit volume, you know, how many hot dogs, how many giant bulk packs of toilet paper they actually sold, it's up.
Member engagement is still really strong.
Very strong. But there is a distinct cost pressure buried in the Sam's Club and U.S. data here that I think is the most relatable point for any actual business owner listening right now.
Are you talking about the new tax legislation, the One Big Beautiful Bill Act?
Well, the Tax Act is definitely interesting. It was enacted in July 2025, and it allows for 100% bonus depreciation.
Right.
Which basically just means they will pay less actual cash tax this year. That definitely helps their free cash flow. But no, I'm talking about the operating expenses line item.
Okay, what's there?
Aside from that massive phone IPO charge we just discussed, there was an additional $0.8 billion increase in the U.S., explicitly related to higher self-insured general liability claims.
Okay, $0.8 billion. Translate that corporate jargon for me. Self-insured general liability.
It is essentially a highly sanitized corporate way of saying the cost of daily accidents. Slips, trips, falls, random injuries in the store aisles or out in the parking lots.
Okay.
Walmart self-insures, meaning they pay these legal claims directly out of their own corporate pocket rather than paying a traditional insurance company a monthly premium to handle it.
And those accident costs went up by almost $1 billion, $800 million.
$800 million, yes. That is a massive unexpected spike.
Why? Are people just getting clumsier?
No, it reflects a much broader legal trend in the U.S. economy right now that experts are calling social inflation.
Social inflation.
It's the documented trend that general litigation is just getting significantly more expensive across the board.
Right.
Juries are awarding much bigger verdicts. Pretrial settlements are getting much higher. And perhaps the overall safety environment is just more challenging to manage post-pandemic.
That is wild to really think about. We spend all this time analyzing their high-tech, fintech investments in India and parsing global antitrust lawsuits from Mexico, but sometimes the biggest actual hit to the bottom line is just a customer slipping on a wet floor in aisle 4.
It all connects back to the sheer, unfathomable scale we started the show with.
Yeah.
When you have thousands of massive physical stores and literally millions of customers walking through those doors every single day, a very slight uptick in the average payout cost of a standard slip and fall claim suddenly becomes an $800 million problem on your balance sheet.
It is the literal tax of doing business in the physical world.
Precisely. And honestly, it perfectly explains why they're so incredibly eager to push e-commerce and digital revenue streams.
Because there are a lot fewer slip and falls on a website.
Exactly. Zero slip and falls on a mobile app.
So what does this all mean for us? We have covered a massive amount of ground today.
We have.
We looked at the billions in investment gains, the transformation of the store into a localized fulfillment center, the PhonePe IPO preparation, and the looming global legal battles.
If you zoom all the way out,
Yeah.
I really think the definitive story of this specific quarter is diversification and complexity.
Yeah.
Walmart is successfully executing a massive pivot. In the U.S., they aren't just a big box retailer anymore. They are a highly efficient logistics company.
That 4.4% e-commerce contribution totally proves they can actually compete on delivery speed with the tech giants.
Right. They prove they absolutely aren't a legacy dinosaur.
And international.
Internationally, they are pivoting away from just selling physical goods to actively building critical financial infrastructure with assets like PhonePe. They are essentially operating as a massive venture capital firm that just happens to have a grocery store attached to it.
But what is the ultimate, so what, for you, the listener?
So what is it? Walmart's bottom line is increasingly dictated by factors that have absolutely nothing to do with traditional retail.
Right.
It is influenced heavily by financial engineering, like those stock market gains. It's influenced by international corporate restructuring. It's influenced by massive legal settlements and social inflation.
It really feels like the very definition of the word retailer is fundamentally changing right before our eyes.
It is.
Walmart is becoming a national logistics company, a healthcare provider, a major fintech incubator.
Oh, and they also happen to sell bananas on the side.
Right. Precisely. And for an investor or just a casual market watcher, you really can't just look at their same-store sales metrics anymore.
Not if you want the whole picture.
You have to look at their entire equity investment portfolio. You have to constantly check the legal docket for that DOJ trial coming in 2027.
Yeah.
And you have to watch the Indian stock market for the PhonePe IPO.
You have to watch everything.
So here is a final provocative thought to leave you with today. We just saw Walmart make over $2 billion purely from their stock investments this past quarter.
Yep.
And they are simultaneously prepping a massive fintech IPO in India. At what specific point does the store, the actual physical place with the metal shelves and the cash registers, at what point does it become just the daily funding engine for a massive global investment portfolio?
That is the multi-billion-dollar question, isn't it?
It really is.
If the profit margins in physical retail keep getting heavily squeezed by things like those liability costs we talked about, and the margins in fintech and fewer investments just keep rising,
Yeah.
we could be looking at a fundamentally different company by the year 2030 than the one we all knew in 2020.
A global holding company that just happens to sell groceries to generate cash flow. I'm telling you, it's a real thing.
I'll strictly stick to the data analysis, but the raw numbers certainly make you think about it.
They absolutely do. Thanks for diving deep with us today. Be sure to check the show notes for the full breakdown of all the numbers and filings we discussed.
Always a pleasure to be here. Keep learning.
Catch you all next time.